All right, welcome back to the deep dive. So it is Friday, February 13th, 2026. And I gotta say, looking at the markets this morning, that date feels a little too on the nose. We've got a sea of red, Bitcoin's taken a tumble back to the mid-60s, and the mood online is it's pretty apocalyptic.
It definitely has that Friday the 13th vibe for anyone just watching the price. But that's exactly why we do this, because if you just stare at the ticker, you're seeing, a tragedy. But if you look at the filings, the actual paperwork from the biggest players in the world, you see a completely different movie. You see a heist.
A heist. Okay, that implies someone is getting away with something big while everyone else is, distracted.
Exactly. While retail is panic selling because of the spooky date and the red numbers, the institutional giants are quietly backing up the truck. Today isn't about a crash. It's about a transfer of ownership. It's the great shift from retail speculation to institutional capture.
That is a very bold claim, especially since the spot ETFs just had their worst outflow day in months. But looking at the research we've got here, I think I see where you're going. We've got 13Fs, we've got MicroStrategy, basically inventing new finance.
And we've got a huge acquisition in Asia that signals the end of an era. Plus, we really need to talk about why yesterday's inflation numbers are the invisible hand behind all this.
Right. So the mission today is to separate that signal from all the noise. We're going to look at the basis trade, these stretch shares from MicroStrategy, and why prediction markets are suddenly in the government's crosshairs. But let's start with the pain. Yesterday, Thursday the 12th, the numbers were just ugly.
They were brutal. I mean, we saw $410 million in net outflows from the U.S. spot ETFs. But the number that really stood out to me wasn't the $410 million. It was the zero. Zero funds had positive inflows, not BlackRock, not Fidelity, nothing. Usually, even on a bad day, one or two funds are buying the dip yesterday. It was flat or selling across the board.
And that mechanical selling pushed the spot price down to, what, 65,000 to 66?
Yep.
Which is, a 48% drop from the peak back in October?
But here's the disconnect, right? The 13F filings, these quarterly reports managers have to file, they show that while the MTS are bleeding now, the smartest money has been building a fortress.
That's the great divergence right there. Look at Millennium Management, one of the most successful hedge funds in history. Their filing shows a $1.94 billion position spread across 5 different Bitcoin ETFs. They bought everything. IBT, FBTC, GBTC, the whole basket.
Okay, play devil's advocate. If they're holding almost $2 billion in these things and the price just tanked, aren't they losing their shirts?
That's the misconception. They aren't actually betting on the price of Bitcoin going up. They don't care if it goes to 100,000 or 10,000. They're running a basis trade.
Okay, we hear that term a lot. Break it down for us. How do you make money without caring about the price? It's arbitrage. So futures contracts usually trade for a bit more than the current spot price. That's called contango. Millennium buys the ETF, that's the spot asset, and at the exact same time they sell a futures contract for the same amount.
So they're long the ETF and short the future.
Correct. They've locked in that little difference, the spread. When the contract expires, the prices meet, and they just pocket that spread as basically risk-free profit.
So they're just using the assets plumbing to farm yield.
Precisely. And they're not the only ones. We saw Susquehanna, Citadel doing the exact same thing. This is what I mean by institutional capture. Bitcoin is becoming a tool for Wall Street's quant strategies. It's just plumbing now.
But it's not just the quants and the hedge funds, is it? I was really surprised to see CalPERS in the data, the California Public Employees Retirement System.
That's the slow money, the really slow money.
Right. And they manage pensions for firefighters and teachers? You'd think they'd run from this kind of volatility.
You would. But even with MicroStrategy's stock taking a hit, CalPERS increased their position. They now own about 470,000 shares, worth around $590 million.
Why would a fiduciary do that? MicroStrategy is basically a leverage bet on Bitcoin. It's so volatile.
Because I think their definition of risk is changing. The day-to-day price swings aren't the biggest risk to them. The biggest risk, if you're looking out to 2040, is the dollar losing its purchasing power. They're treating these shares as a long-duration reserve asset. They're hedging against currency debasement over the next decade.
So they can handle the Friday the 13th volatility today because they're worried about, Friday the 13th in 2035.
That's it, exactly. And speaking of conviction, you have to mention ARK Invest, Cathie Wood's firm. While everyone was panicking, ARK was out there buying the infrastructure. They added to Robinhood, BitMine, the exchange bullish.
But pick and shovel play, don't mine for gold, sell the hardware.
And the hardware store always has better margins.
Let's pivot to MicroStrategy because you just mentioned them. We have some notes here on what we're calling financial alchemy. They've come out with this new instrument that's confusing a lot of people.
It's a fascinating piece of engineering. It's called the Series A Perpetual Preferred Stock, but the market's calling them stretch shares.
Stretch shares sounds like something out of a yoga class. What problem is this trying to solve?
A simple one. MicroStrategy holds Bitcoin. Bitcoin pays no yield. It's a digital rock. But they want money from insurance companies and pension funds. And those investors need cash flow. They need a check in the mail.
So how do you squeeze yield out of a non-yielding rock?
You build a wrapper around it. These stretch shares pay a fixed dividend of 11.25%.
Whoa, wait, 11.25%? The 10-year treasury is what, 4-ish%? That's an enormous yield.
It's massive. But here's the genius part. This stock is preferred, so it sits higher up in the capital structure. It isolates those investors from the wild swings of the common stock. They just care about getting that dividend paid.
So they're raising $300 million from these conservative investors, paying them that huge dividend and using the cash to do what?
Buy more Bitcoin. They're literally transforming Bitcoin from a volatile asset into collateral for a high-yield credit instrument.
But isn't that incredibly dangerous? If Bitcoin crashes, how do they keep paying that 11%?
That is the risk. But Michael Saylor's betting he can manage that volatility. He's forcing every corporate treasurer to look at their own balance sheet and ask, why am I earning 4% on my cash when these guys are doing this?
It's a perpetual bid for Bitcoin, funded by the bond market. That's wild.
It's either the peak of financial engineering or the absolute limit.
Yeah.
We'll see.
Okay, moving from one giant to another, Coinbase. Their Q4 earnings came out, and the headline was a disaster, a net loss of over $666 million.
Look terrible. But this is where you have to, be an accountant.
Yeah.
That loss is almost entirely a paper loss. It's an accounting change.
Is this that fair value accounting rule we've talked about?
Yes, from FASB. They now have to mark their crypto holdings to the market value each quarter. So because prices dipped right at the end of the quarter, they had to report a huge unrealized loss on paper.
But no actual cash went out the door. They didn't write a check for $666 million.
Not a dime. In fact, if you look at their cash flow, they generated over $3 billion. They have $11.3 billion in cash just sitting there. They are a fortress.
$11 billion. That's a serious war chest. And I saw a stat about their custody business that is, frankly, kind of terrifying.
It's staggering. Coinbase now holds over 12% of all crypto assets in existence.
12% of everything.
One U.S. company holds the keys to more than a tenth of the entire asset class.
That's getting into too big to fail territory if something happens to them.
It's systemic, and they're using that dominance to pivot. They're adding commodities, gold and silver trading, and this is the big one, prediction markets.
Which brings us to this huge regulatory battle that's just starting to heat up. I feel like prediction markets just exploded into the mainstream after the Super Bowl this month.
That was the breakout moment for sure. The platform Kalshi saw $1 billion traded just on the Super Bowl.
Yeah.
That's up like 2,700% from the year before.
And it wasn't just betting on the score. I read people bet over $100 million on what the first song of the halftime show would be.
It's the gamification of everything. But the regulators have woken up.
Yeah, SEC Chair Paul Atkins did not sound amused in his testimony this week.
Not amused is an understatement. He called it a huge issue. And it's triggered this rare moment of unity in D.C. They're launching something called Project Crypto.
Project Crypto. Sounds like a bad action movie. What is it?
It's a joint task force. The SEC and the CFTC. For years, they've been fighting over who regulates what. Now they're teaming up specifically to create a rule book for these prediction markets.
Why them specifically? What's the problem?
Because they blur the lines. The SEC is arguing that these bets look a lot like security derivatives. And if they are securities, then these platforms need to register as national exchanges.
Which basically kills the fun. It brings all the rules and disclosures and oversight.
It kills the Wild West vibe. But while the U.S. is building fences, look at what's happening in Asia. This might be the most important story of the week.
You're talking about that deal in South Korea, Mirae Asset Group buying Korbit.
Exactly. Mirae is like the Fidelity or Vanguard of South Korea, a huge traditional finance firm. They just bought 92% of Korbit, a major crypto exchange, for around $92 million.
But why? The Korean crypto market has had so many scandals.
That's why. Remember that phantom coin glitch at the Botham exchange a few months back?
Vaguely,
They accidentally credited users with billions in fake Bitcoin. The whole market froze. It was a complete disaster. Trust was destroyed.
Right.
So who steps in? Legacy finance. Mirae is basically swallowing the crypto industry there to save it from itself. They're going to integrate crypto trading right into their normal banking apps.
So you go from some sketchy exchange app to just a crypto tab in your bank account.
That's the future. In the US, regulators are clamping down. In Asia, the banks are just buying the whole thing. It all leads to integration.
Okay, so let's tie this all together. We have all this institutional adoption happening, Millennium, CalPERS, Coinbase, Mirae. If the foundation is getting so strong, why are we staring at a red chart? Why is the price stuck?
It all comes back to the macro anchor. The economy,
The inflation data.
the January CPI data that dropped today, it was sticky. Headline at 2.4%, core at 2.5%.
Still above the Fed's 2% target.
Stubbornly above it. And that is the wet blanket on this whole market. Because inflation is sticky, the Fed can't cut interest rates. And that leads to opportunity cost.
Walk us through that.
If you're a big asset manager, you can buy a risk-free government bond right now and get a guaranteed 4 or 5% return. Zero risk.
Yep. Right. Versus owning Bitcoin, which pays zero yield and can move 10% in an afternoon.
Exactly. High interest rates make holding a non-yielding asset like Bitcoin very expensive. That explains the $410 million outflow we started with. The allocators saw the inflation data coming, got nervous, and just rotated into cash and bonds to de-risk.
So the price drop isn't about Bitcoin failing. It's about the Fed's fight with inflation.
The network is working fine, the adoption is accelerating, but the macro environment is a headwind. It's a tug of war. High interest rates are pulling the price down, but this deep institutional buying is pulling the floor up.
So to summarize for everyone listening who's feeling that Friday the 13th anxiety, what we're really seeing is a clash of two different stories.
We are. The short-term story is rates are high, sell risk. That's why the price is down. But the long-term story is this great shift. Hedge funds providing liquidity, pension funds using it as a reserve asset, and banks just buying the exchanges outright.
The infrastructure is being cemented in place.
The concrete is pouring even if it's raining outside today.
That's a great way to put it.
But, and here's the thought I want to leave everyone with.
Go on.
This great shift, it comes at a cost. We are watching the death of the crypto-native startup. Look at the prediction markets, about to be crushed or absorbed. Look at Korbit, swallowed by a bank. Look at the ETFs, completely dominated by BlackRock.
It's all becoming
corporate.
It's becoming boring.
Regulated. A part of the global banking system. The days of anonymous founders in the Wild West are over. We all said we wanted mass adoption, right? Well, this is what it looks like. It looks like pension funds and bank acquisitions and accounting rules.
It looks like suits, not hoodies.
Exactly. And the question for you, the listener, is that what we wanted? Is a Bitcoin that's been fully captured by Wall Street still the revolution we signed up for? Or is it just another asset on a Bloomberg terminal?
That is a heavy question to take into the weekend, but a really important one. As always, don't just watch the price. Watch the plumbing. That is where the real story is. Thanks for diving deep with us.
Stay curious.
We'll catch you next time.